Well, Nigeria's Central Bank Governor, Godwin Emefiele, will shortly outline the position of the Monetary Policy Committee in its last meeting of the year. Now, a surprise 100 basis point cut was a decision taken by the MPC at its last meeting in September this year, coupled with an adjustment of plus 100 and minus 700 on the asymmetric corridor around the monetary policy rate, while other policy parameters were left unchanged. Now, recent data from the National Bureau of Statistics confirmed that Nigeria is now officially in a recession after recording another quarter of negative growth. Meanwhile, inflation rose to 14.23% in the month of October. So what can we expect from the committee in its last meeting of the year? Bismarck Rewane, CEO, Financial Derivatives, Nnamdi Nwizu, Co-Managing Partner at Comercio Partners, and Gregory Kronsten, Head Macro and Fixed Income Research at FBNQest, join me for today's analysis. Thank you, gentlemen. It's a pleasure to have you on this special MPC broadcast. Now, I'm just going to throw a general question, starting with Bismarck. What is going to be high on the agenda for the MPC in this last meeting of the year?
The big difference between using historical inflation and using anticipated inflation. Over the years and over this last 3-4 years, what has happened, the central bank has always used historical inflation to determine what the way forward is. For the first time this time, I think what will weigh most on the minds of the policymakers is what is the anticipated inflation rate coming December, January, because that inflation rate will determine to a large extent what the value of the currency will be and the level of pressure which will affect interest rates and investor expectation. So I think for the first time, we are going to see that shift in emphasis from using historical inflation as the anchor to using anticipated inflation as a directional guide.
Nnamdi, can we hear your thoughts, please?
Thanks. I think major thing will be how the central bank decides to deal with stagflation at this point in time. The last time, 2016, that we had a similar, we're in a similar position. What they decided to do at that point in time was to raise rates to attract dollar inflows from FPIs. We don't expect that to happen this time. So the major thing for me will be what will they decide is most important to them at this point in time. Is it the economic growth, or is it fighting inflation and managing the currency? So we'll wait to see, how that plays out.
Yeah, that has definitely always been a big conundrum for the MPC. Gregory, what are you expecting from the MPC today in terms of priority?
Well, thank you, Esther. Well, we've had 2 shocks this year already. I do think we're going to get a third. I look forward to Bismarck's hint about inflation expectations. That will be very interesting. I expect we'll have no change. I expect we'll have an update on the central bank's development finance role and on credit extension. Now, these have been the 2, well, let's be diplomatic, say 2 successes. So I expect an update on both of those. But no change, I think. I don't see how. We all know that most of the sources of inflationary pressure are supply side, but therefore, supposedly, textbook says monetary policy can't do anything. But we've had more than 12 months of rising inflation, accelerating inflation. So I think I really don't see how they can ease again this time.
As we all know, before now, we've all been digesting a number of major economic data, inflation inclusive. Before then, just after then, we also got the GDP data for the second quarter, down 6.1%, of course, rather just over 3%. And of course, that then took us into that recession. Now we've been dealing with a myriad of challenges, COVID-19 pandemic, the subsequent lockdown, and then we had another sort of lockdown, excuse me, if you will, following the EndSARS protest, the border closure, disruptions in the food belt, banditry, so many farmers having to abandon their farms due to the banditry. Bismarck, this question is for you. Just, reflecting on all those factors that have played out in the course of the year. I mean, we're already in a sort of a weak position, that's the economy now. And then we had those factors exacerbating the condition in which we're in. But as you reflect on those major indicators, I mean, how much work does the MPC, and by extension, even the central bank itself and the fiscal authorities, how much work do they have ahead of themselves?
I think the work of policymakers in Nigeria is cut out for it. You have a stagflation situation. You have oil prices that are volatile. You have OPEC cutting back on your quota. And you have an end-SARS impact, which is in Q4. The data you have today on Q3 does not take into consideration the end-SARS impact and the disruption effect, which started October 22nd. So what that does is actually it delays the recovery. So if you get in a U-curve recovery, you are going to have an extended stay at the bottom before you now have a recovery. But luckily, what we see is that 2021 seems to be a year of recovery because of two things. One, the vaccine, and two, the fact that the rest of the world is going to recover maybe much faster than we thought. And so Nigeria, by extension, is going to benefit from that. But at the same time, the structural defects that are in the Nigerian economy still have to be addressed. And the Nigerian policymakers have to actually understand the limitations of monetary policy as a way of solving fiscal problems. And also, more than anything else, the size of government expenditure as a percentage of total GDP. The budget itself is 13 trillion naira and a GDP of 147, 155 trillion naira. So it's minuscule. What we need to see is to accept that using the budget as a tool to affect total economic outcomes has its limitations. And these are things that we are going to grow into and accepting the reality of our situation.
Now, speaking about the budget, Nnamdi, let me bring you in here. We did see the federal government and the FEC approving the new Finance Bill 2020. So it's meant to help support the budget, and we're hoping that going forward that this is going to be a regular, going to be a regular thing. We also know that, contained within that finance bill is the reduction of the tax burden on certain categories of businesses. The finance minister has said there will be no increase on taxes, of course, given the current environment. But what are your thoughts in terms of how, Bismarck just mentioned the budget, outlook for revenues, and also how the fiscal authorities plan to support, especially small businesses, and ensuring that, look, we need to begin to create, empower or strengthen the SME sector so that they can begin to create those much needed jobs. I think we can all agree that the government cannot on its own create jobs. The private sector is supposed to be in the forefront of job creation.
I totally agree with you that the private sector is extremely key to job creation. It's a bit of a conundrum because you're talking about reducing taxes for small businesses, which I understand as a means of trying to get them to, kickstart their activities and all. But at the same time, the government also needs to raise revenues. So if you, remember the last time government met up to say about 50 or 60% of its revenue targets, right? So even if you look at this year, last year, 10 trillion budget, this year you are 13.08 trillion budget. Last year, I'm not sure they made up to, this year, 2020, I'm not sure they're going to make up to 60% of their revenue target. So now you have an increased figure again, out of which you have about almost 24% going towards debt service, and then you have about 28%, which will go towards the salaries and allowances. So you have almost about 51 or 52% thereabouts, which will be used as debt service / salaries. So what you now have left to actually help in trying to boost the economy and trying to ensure that you have that growth, which is extremely key. So yes, small businesses are extremely important, but like I said, for government, where would the revenue come from? And if we are looking at complying with the OPEC cuts, we know that means that most probably won't meet our benchmark for crude oil production unless we see real demand start to kick in next year. We all know that the vaccine might not become readily available until maybe late Q1 or sometime in Q2 next year. So that real demand that we see for crude might not actually come in up until then, which would allow OPEC most probably lift the cap that they have on their on crude oil production. So it's going to be a tough one, still a challenging environment for government next year with regards to revenue. And then even looking at the budget and looking at the percentage going into capital projects, just about 3.85 trillion. It's a bit of a worry to ensure that we can achieve what we want to.
Gregory, I'm sure you've watched with keen interest how events have played out this year at the fixed income market. We're seeing yields at record lows, and I believe we had a negative at the Treasury bills market last week, a negative rate for the first time in recent history. Now, while this has positives for the fiscal authorities from a debt service and a borrowing point of view, I mean, one, it would all suggest that the government is trying to, reduce that for investors now, the return on investment, and push them to invest in the real economy. But then, of course, investors could argue that, look, what is the state of infrastructure? Are there enough enabling policies? How enabling is the business environment? But what is your take on how events have played out at the fixed income market and the situation that institutional investors like PFAs have found themselves in?
Well, I think PFAs are, they have to make some decisions, don't they? Because under the when you had 12%, 15% on your FGN bonds, decisions were quite easy to make. But now we've come down. Even the longest maturity FGN bond under 7%, if you go to the short end, is negligible. So but you have to ask yourself, there are two questions here. The point is, what are the alternative investment decisions, options available to PFAs? And if there are not many such, then you can see institutional demand is going to remain for government debt. Now, the other part of the equation, of course, the difference in the market now and 1 year ago was that the market now is of very little interest to foreign investors. I mean, well, there's still some who are waiting for their own mobiles to mature. But to be honest, you really can't see a return of FPIs. And the return of FPIs raises the next point, which you've come up with, which is that the FPIs have been basically financing the current account deficit for quite some time, or since the various exchange rate system came in. But now this is no longer the case. So we got some big difficulties here. I mean, I think probably the DMO is not overly worried because of it has not a captive audience, but let's say an amenable audience among domestic institutions. But in terms, for the foreign investors, it's not really an interest. I mean, the interest now is Egypt, basically. If you're looking at fixed income, local currency in Africa, it's Egypt.
Absolutely. Bismarck, let me bring you in here. We have also been, as you probably already have been, tracking the Naira. Now, when the CBN decided to intervene at the BDC market, we saw that slight appreciation in the Naira, but then the interventions have continued, yet we're seeing the Naira weakening, at least in recent time. I was looking at the Naira versus the dollar today. It's at 480. I'm just wondering, what is your take on the management of the Forex market so far, the CBN trying to ensure that the Forex reserves are still at reasonable levels while also trying to clear that backlog of FX demand from offshore investors?
I think to look at these indicators in silos is part of the difficulty all of us are, and the fallacy of economic policy decision making. If you have interest rates at 1% and you have inflation at 14%, obviously the store of value of that currency, the characteristic of store of value is eroded immediately. Therefore, the difference between the two should actually give you the interest rate that you use, that you will have nominal interest rate, which will give you some kind of equilibrium. So as long as that difference exists, the pressure will continue to be on the domestic currency. Yes, the nominal rate, the nominal official spot rate is 386. The effective exchange rate is 480. There's 100 naira difference between one and the other. So you have to come to terms with the fact that this is the reality. So as long as you have that interest rate disparity, that differential, and you think that you can control demand by selling 150-day forwards, we are just playing again with the level of evaluation is very simple. It's clear, and I think the central bank understands that. But secondly, for every 1% devaluation, there's a 0.2% pass-through on inflation. So if your currency is 10% overvalued, you will have a 2% pass-through. Your inflation rate, if you correct it, you will have inflation go from 14 to 16%. And if the inflation goes to 16%, then you know what you have to do to your interest rates. So yes, it is interesting that the DMO is enjoying some subsidy in the market, but there's a price to be paid for that. And that price is a weakness in the external sector and the fact that your currency comes under additional pressure. And inflation more at a rate higher than 12%, according to the central bank, is growth retarding. You will get nowhere if you do that. And more importantly, is the fact that because Ghana and a couple of other countries, the US, EU, are bringing down interest rates, they don't have inflation of 14%. They don't have inflation going towards 16%. They do not have food inflation of 17.25%. So we are not in the same place. And therefore, our solution at the end of the day means that we've got to change the trajectory of our interest rates to make sure that we can mobilize savings, because it is savings that is equal to investment, and it's investment with a multiplier that gets the economy back onto growth, on a growth path.
Well, that is absolutely right. We're just receiving news that the central bank governor is seated and will begin to speak in the next couple of minutes. But before that happens, Nnamdi, just quickly, just a comment from you, listening to what Bismarck said just now. Obviously, the MPC members do have their work cut out for them, but what are your thoughts? I mean, Naira, we're at 480. I mean, we know that there will be that oscillation, and we have actually seen a slight uptick in oil prices on, of course, positive news from another third vaccine, I believe. But what are your thoughts around the Naira at this point?
So, I mean, I think he was pretty much spot on, and as part of what I mentioned earlier, we have the challenges that we need to face. So basically, do they focus on inflation, or would they still focus on trying to manage the currency or trying to stimulate growth? So those are the major questions, the major things that they need to target to get the currency under wraps. We know that there are, a few major things. One would be to try and increase the inflows from FPIs, but definitely nobody's going to come considering where interest rates are. And the second would be to restructure the economy and stop us from being a monoproduct economy, more or less, which takes time. And to be honest, I'm not sure if agriculture would take us to the promised land. We need to diversify beyond just focusing on just agriculture if we're trying to improve or increase our dollar inflows. So I totally agree. I mean, we know that we're an import-dependent economy, so to a large extent, the valuation of the currency directly impacts our inflation, and you can even look at that with food inflation being extremely high levels. With the last reported figure, I think it came to about 17% or thereabout.